Hello, everybody. Welcome to this month's Move Smartly market update for September. My name is John Pasalis, president at Realosophy Realty. For those of you who've been on these before, I like to host this live kind of monthly sort of market update to discuss all of the trends that I'm seeing in the market. I, of course, publish a monthly report. For those of you who haven't seen that, we have the link in the description. But in this discussion, I kind of try to look at stats a little bit differently as well. And as I'm preparing, I often see trends that kind of I hadn't seen when I even prepared my report. So we're going to go over some of the trends I'm seeing. And obviously, this is a great way for everyone to ask any questions you might have about what's going on in Toronto's housing market on the ground. So here's a kind of a brief overview of what we're going to be chatting about. I'm going to kind of discuss the latest trends for houses and condos on the ground. We're going to unpack the regions that are seeing the biggest increase in inventory. I'm going to talk about the precarious fall market for Toronto ahead and why I think it's going to be a precarious market. And then finally, we're going to bring in David LeBrock, mortgage broker, who writes for Move Smartly and has a really, really great column he publishes every week and really in tune with what's going on with the latest mortgage trends, Bank of Canada reports, all of that great stuff. As always, please post your comments in the Q&A. Urmi Desai from Move Smartly, our editors, keeping an eye on those. And of course, we'll ask them periodically throughout today's discussion. Anyone who has any specific questions, or needs more personal advice, you can always connect with me by just going to movesmartly.com/meetjohn. And finally, for those of you who've been following our podcast and YouTube channel, you'll know that I launched a 1-hour webinar on the top 10 home buying strategies to give you an edge. I'm actually going to be updating this webinar, so if you have seen it, you may want to go back in the next couple of weeks, because the strategies are a function of what's going on in the market. And the market today is a little bit slower, and in a slower market, some of the things that we do, how we value homes, how we negotiate, all of those things are actually a little bit different. So I need to unpack that to explain that. So keep an eye on that if you want. I'll be updating that again for the fall market. And you can find a link to that in the description as well, in the show notes. So moving forward with the latest statistics for Toronto's housing market. So this shows we're looking at the number of sales for detached homes for the month of August. And the interesting trend, I mean, I published a chart like this for my monthly report that looked at all sales. And the stats are actually a little bit different when we look at just detached homes, because they are actually the lowest number of sales going back to 1998. So the number of detached homes that sold in August, August is traditionally a slow month for seasonal purposes. But what we're looking at here is that the slowdown in the market for low-rise homes and in detached in particular was not just about seasonality. I mean, like I said, we're with the lowest lowest number of sales for the month of August, going back to 1998. I mean, and just think about how much bigger a city we are and how many homes we have compared to 20 plus years ago. So it's a very, very soft market right now. And again, this is largely just driven by the fact, some of the trends that I've been talking about on here the past 2-3 months, that, with rates increasing, it's become more challenging to buy a home. And it's not just the Bank of Canada's couple of rate hikes over the summer. It's primarily driven by the fact that most people are getting fixed mortgages, and those are over 6% today. And earlier this year, you could probably get a fixed mortgage just under 5%. And that difference, that 1 to 1.5 almost percent difference, is having a huge impact on affordability and people's ability to buy homes. And this is largely why sales are pulling back. Now, when we look at new listings for detached homes are largely, a little bit below historical trends. but are kind of getting closer to sort of historical volumes. When we started the beginning of the year, we were at sort of record lows for new listings, and that's why the market was so competitive, because no one was listing homes. Now new listings are increasing, but sales are pulling back, right? And what that's doing is causing inventory levels, or the months of inventory, to increase. So the months of inventory just looks at how many homes were available for sale at the end of August, how many homes sold, and if no other homes got listed, how long would it take for all those homes to sell? And we're basically at 3 months of inventory, which is, not a terrible market, but Torontonians are used to a very competitive market. So 3 months of inventory is actually relatively slow. It's getting close to what we saw in 2018, which is a pretty soft and sluggish market. So the market's still moving. People are buying homes. Their homes are just sitting on the market a lot longer. And again, this is just a function of the fact that buyers are pulling out of the market. When we look at what has happened to prices for low-rise homes, so that's detached semis, row houses, average was 1.328 in August. This is actually down about 10% from May. So what happened was prices were flat for the end of 2022. Then they kind of surged up in the first half of this year and have now kind of dipped back down. So we're largely back to levels that we had sort of in the fall of 2022. So we are seeing this slowdown reflected somewhat in average prices as well. Now, when we look at the condo market, the dynamics actually, interestingly enough, are a little bit different. Condos did not see a 20-year low in sales. Sales are below historical trends, but, slightly above last year, kind of close to 2012 levels, a little bit below 2014, 2015. So, we're below historical levels, but certainly not at, I guess the detached is actually at a 25-year low. So we're not quite there. So sales are softer, but not quite as soft as detached homes. But new listings, on the other hand, are actually at the highest level they've ever been. If we exclude, for the month of August, that is, if we exclude 2020, which saw a boom in new listings because of COVID, the market had kind of frozen in April, May, June. And then everyone, after hitting pause for 3 months, listed in August. So if we get rid of the 2020 spike due to COVID, the number of condo listings are basically, for the month of August, at the highest level they've ever been. And this is something that we're seeing on the ground. We're definitely seeing more investors wanting to deleverage and sell a property here or there. Usually investors have kind of maybe 3-4 properties, or selling one to kind of take some money off the table to pay down debt, to ease the burden. So we're seeing that kind of reflected in the statistics as well. So when we look at, again, inventory levels for condos, they have increased to, again, over 3 months, about 3.5 months. And prices for condos are, average prices for condos are at $737, down about 5% from the peak. Condos did not accelerate as much. Sorry, I should say the peak of this year of May, not the actual peak, which was last year. So we're down about 5% from 5 months ago. We're roughly in line with last year, again, sort of at fall 2022 prices, but down a little bit from 4 months ago or so. So that's a little bit about some of the stats we're seeing on the ground. Now, one interesting thing to look at is looking at what regions saw the biggest increase in inventory. So there's a statistics or a chart posted online recently by Ben Rabideau, who's a housing analyst, and his firm Edge Realty Analytics, that basically looked at the change in the number of active listings between May and August in the past. And basically what he's trying to see is, okay, how do new listings, or how do active listings change? Now, historically, if we actually look at the history of this over, back to the 1990s, usually we see the number of active listings decline between May and August. Usually we have way more houses available for sale in May than we have in August. And the decline is anywhere from 10 to 20%. So we see usually 10 to 20% fewer homes available for sale in August than in May, right? And this is a typical trend. The only two years where the trend is sort of the opposite, where active listings were higher in August, was in 2020, again because of COVID, because a lot of people were not listing in May. So we saw a flood of listings in the summer. And this year. So this year is the only other year where the number of homes available for sale is higher in August than it was in May. And again, I think this is function of a lot of things. Number one, like I said earlier this year, there was just not a lot of new listings. So our base was actually quite low. Demand was, normal, not incredibly strong, but there just weren't a lot of listings. And now as we move towards the summer, the trend has kind of reversed. Sales have been plummeting, new listings have been increasing, and this is actually why we're seeing more inventory. So when we break out, so new listings today, not new listings, active listings for the month of August were about 30% higher than they were in the month of May. And when we look at this breakout by region and by house type, we kind of see that most of the increase was actually in some of the suburban markets. Durham, Halton, Peel in particular saw sort of the biggest increase in the number of active listings. York was behind that. And then Toronto, especially Toronto for houses, was the lowest. I mean, why are these differences? It's hard to explain. I mean, I don't have an answer for why new listings or active listings in Toronto are much lower than in the suburbs. I'll have to dig into some of the reasons behind these trends, but this is, what we're seeing on the ground. Sort of the active listings counts are a little bit higher in some of the suburban markets, both for houses and for condominiums. They've kind of outpaced sort of the city of Toronto downtown. Now, I'm going to wrap up this section by just taking a look at the fall market and what are the trends we're expecting to see. 1 second. I'm just making sure we have David LaRocque with us. Urmi, maybe if you can kind of send David a text to make sure he's going to join us. Just so the fall market, I mean, the fall market is probably going to be, this is going to be one of the most interesting and important fall markets, I'll say, because again, we're starting to see the impact of these higher rates kind of filter through the housing market. And usually it takes time for higher rates. And I've been talking about this on this channel for some time, both with David LaRocque and with Steve Soretsky on our roundtable, that it takes time for people to sort of feel the weight of these higher interest rates. Usually as they're renewing their mortgages or when they feel the increase in their HELOC payments, and we're starting to see that right now. I mean, I'd say the vast majority of people we're talking to who are considering selling are investors, and these are like I said, investors who they're not like the distressed investors you think of like in the US financial crisis where people just mail their keys and walk away from the home. Many of them have equity in their properties. Many of them have, 2 or 3 or 4, but they just want to take some money off the table. They want to pay down debt. Many of the ones that I speak with are also, they'd like to sell, but it's like they're not desperate to sell. Many of them are telling me that if they can't get a certain price, they'll just rent it out, which is obviously fine. So when we think about sort of what are the dynamics that might impact the market, it kind of goes back to the trends that I was talking about at the beginning, which is sort of this balance between new listings and sales. So new listings are kind of close to historic levels. I mean, for condos, actually, they're at sort of the highest they've been for the month of August. Low rise is below that, but they're picking up. So if new listings continue to accelerate, right? So if we see more and more homes listed for sale over the next 2 months, and sales remain soft, this is going to allow inventory to build, right? So the number of active listings will continue to increase. And we'll basically see homes sitting on the market a little bit longer, taking longer to sell. And that will be quite important to see what happens. And I think the important thing is going to be usually in slowing markets, prices are relatively sticky, meaning they don't just plummet overnight, right? Usually sellers are stubborn, they want a certain price. But in a slowing market, you don't know how many desperate sellers there are out there. And this is, one thing we talk about with our clients who are selling homes is that sometimes in markets like this, we're kind of in a rising market, everything's great because your neighbor sells for a decent price. You're kind of less vulnerable to sort of the whims of kind of what your neighboring sellers do, because it is the buyers that are driving the market and the price is up usually. In a slowing market, the challenge is, we're all as homeowners and sellers a little bit vulnerable to what our neighbors are doing and how motivated they are. And if a particular homeowner is desperate and just needs to sell because they're significantly over leveraged and sells for less than, in theory, what their home is worth, this can kind of, almost set a new bar for prices in the area. What's interesting about the housing market is that when prices are rising, when someone pays way above market value, it doesn't necessarily push prices up. Most people look at that and think that guy overpaid, this is what homes are worth. But when markets are slowing down and buyers see someone, get a deal, so to speak, well, then the psychology changes and buyers all want that deal. And it kind of, and this is why sometimes if some sellers are desperate and they sell for a lower price, it can impact the other people who are on the market. So I don't think we're quite there yet. Definitely prices have softened a little bit from the peak. So as buyers and sellers, one thing that's important to keep in mind is that, you don't want to be using comparables from February, March, April, when prices were considerably higher, right? You want to be looking at what has sold very recently when you're thinking about what a reasonable value is for the home that you're looking at buying and the home that you're looking at selling. So again, we'll be keeping an eye on some of these dynamics, how the market's evolving. But right now, I'd say things are relatively stable. We're seeing, of course, more inventory, but we're not seeing, we're seeing somewhat stability in the housing market, which is a positive thing. So I don't know if we have any kind of questions from viewers, Urmi, before we pull David on.
Yes, we do. So from Connie, it seems like it's a buyer's market, but it's not, because inventory and sales are still low from what I understand. What's the reading on how buyer sentiment is in the market right now? And then we have another great comment from a buyer, but why don't you answer that first?
So, yeah, it definitely, so, when we think about what makes a buyer's market versus a seller's market, I mean, months of inventory is usually kind of one metric, but it's not a perfect measure because, what makes it, like, for example, Vancouver, I feel like typically has far more inventory than Toronto does, right? And I'm going to stop my screen here because we don't need to be have the presentation up. So inventory levels right now at 3 months, I'd say are relatively balanced. So we're kind of at a balanced market, but it feels like a buyer's market largely because there aren't a lot of buyers. There are more listings than buyers. Buyers are patient, and affordability is strained, right? So I think I'd say definitely, and one of the things that makes it feel a little bit more like a buyer's market is that homes are staying on the market longer. There are far fewer multiple offers. When there are multiple offers on homes, they're not getting crazy prices, or they're not getting a lot of offers. So it definitely feels like a little bit more of a buyer's market. Now, again, I think one thing I didn't touch on at the beginning, sort of when I'm talking about the fall market, and this is what makes it tricky as a buyer and as a seller, that these dynamics are actually very regional and a function of the type of home that you're looking at, right? So again, if you're looking at, a detached home in East Willenbury, that market is going to be very different if you're looking at a semi-detached in my neighborhood of Leslieville or whatever, somewhere else downtown. So the balance between demand and supply can actually be very different depending on the neighborhood. and even the price point you're looking at. So I think that's the one challenge that people needs to be thinking about. That's not like, and so I talk about the broad GTA statistics, but as a buyer seller, you got to be looking at the dynamics in the specific area that you're looking at.
Great. And maybe Dash is talking to us from a slower part of the market. Dash, tell us where you're looking. I feel like buyers, myself included, are not willing to get into bidding wars. It also appears that houses are remaining on the market for weeks, many getting delisted and relisted at lower prices. So are you seeing that, John?
Yeah, 100%. You know, it's depending on the area, again, like higher end for sure. Like many of the listings I saw coming up in September, I was like, that place was on the market in May and in June. They just took it off and relisted it. And this is a typical seasonal trend. I think when people don't sell in the summer, they just cancel the listing and relist it. The question is, obviously what segment of the market and how long are they in the market, and are the sellers priced high and unrealistic, or are they priced at market value? I think the comment about buyers not willing to get into bidding wars, I think there is some truth to that depending on the market and the type of property. Of course, if you're listing a $1.4 million home for $999, you're going to get a lot of people interested, but most people who are bidding on that are hoping to get a steal. So it's a bit misleading when a lot of agents do that. But on that note, I'm going to unpack another trend we've been talking about in our sales meeting. I meet with my agents every Tuesday, and it's such a terrible trend in this industry. And that is, okay, there's like a few ways to price homes. Number one is, what's our timeline? Okay, we're good. You either price low, like artificially low to get a bidding war, and you hope to get way over asking, or you price at the price that you want and you just wait and you're kind of taking offers anytime, right? And, you're hopefully going to get a price close to what you're asking. What some agents are doing right now is, let's just say they have a home that is worth $900,000 and that's what the seller wants. Well, they list it on the market for $829,000. They do not have an offer night. They're just accepting offers anytime. But when you make them an offer for $829,000, they say, no, we want $9,000 or we want $920,000. And it is such a terrible practice because, like, honestly, if an agent is advising, like, you should not do this. You're kind of doing a disservice to yourself as a seller. It's misleading buyers, you know what I mean? Because buyers have learned that if a home does not have an offer night, this is what the seller expects. So they just end up wasting everyone's time by pricing it low, taking offers, sitting on the market for 30 days, and they still want, $100,000 over the asking price. It is such a ridiculous pricing strategy, and something I would definitely not do if I was selling a home in today's market.
Thanks, John. And Dash just follows up saying, I sold our house in Mimico and I'm looking for a house in Whitby. I have my proceeds from the sale parked in a redeemable term loan at a pretty good interest rate and renting until I can find the right house. So Whitby is probably one of those areas, John, that you are seeing more listings, more choice, or?
Yeah, we're definitely seeing more listings, more choice. In terms of months of inventory, I think it is actually a little bit tighter because it's more affordable. But Dash did something that I think is the good thing to do. Before we bring on, I'm digressing a little bit, but there's always this tension if you need to buy and sell, right? If you need to do two transactions at once, which ones do you do first? And at the start of the year, most people were buying first because the market was hot and it was like a guarantee that their home's going to sell. It's going to sell quickly and at a certain price. In a slowing market like today, it is so unbelievably risky to buy first and then sell your home, right? Especially if you have to sell your home, because you don't know how long it's going to take. You don't know what the activity is going to be like, and you're less confident what the price is if you need to rush and sell it. If you need to sell your home in 30 days, you're effectively a distressed seller, right? Because you have to take whatever price the market gives you if you're not getting the price you want by the end of that 30-day period, because you have to sell to close. The only situation where it's fine to do that is, if you don't need to sell your home. If you can buy your next home and not necessarily sell your current one, then fine. But otherwise, in today's market, I think what Dash did is probably what the smart move is, to sell your current home, lock in your money, and then move, because it's less likely that prices are going to accelerate in the next 6 months, and you have way more security and certainty about your sale transaction.
Okay, great. A few quick ones. I know we have Dave on board from Riaz. Here's a question. And again, John, it's about the short term versus the long term, I think, ultimately. Right now, we're starting to see listings climb in the single home category in some areas of Toronto. On the other hand, we've seen headlines of builders not applying for building permits due to the high cost of interest, as Riaz points out. So we've been hearing about new housing starts. Often that's the inventory for new homes being built dropping. So what happens in 2 years? Is that too far out? Does it just mean that our long-term shortage is probably there?
Yeah, I mean, I do think we have a long-term supply shortage. I mean, certainly. I mean, our population is booming. We're not building enough homes. And I think most people who I speak with, and I tend to agree with them, believe that whatever happens now is a short-term dynamic due to the strain of inflation and high rates, right? So where prices go over the next 6 to 12 months is unpredictable. But I do think most people who follow the market kind of agree that the second rates start declining, the market is going likely to rebound. Like, I've never met anyone who thinks that we're going to have like a 10-year bear market where prices are falling for 10 years or even 5 years, right? And again, I think largely because we have these dynamics right now. And again, how long the market is sluggish depends on how long rates are high. But I do think that once rates dip, I mean, even if rates dip below 4% or 5% in the fours, that's a huge difference. And this is actually what triggered more buyers to get into the market earlier this year. But who knows when that's going to happen? Maybe Dave can give us some insight on when he thinks rates might dip a little bit.
Okay, let's end with a quick comment on the luxury home tax you mentioned on Twitter. Right now, that's just, it's a suggestion, isn't it, towards City Council, backed by the Toronto Mayor, Olivia Chow?
Yeah, so City of Toronto is looking at increasing the land transfer tax on homes above $3 million. It's a terrible policy. I mean, most people don't like taxes, but it's terrible because it distorts the market. It makes it harder for people to upsize because now they have like another 100 or 2 or 300,000 in taxes to pay. And when people can't upsize, it doesn't free up the inventory of homes that are well below $3 million, right? So they're only expected to make $25 million out of this. They could have increased everyone's property taxes by $25 in Toronto to achieve the same revenue, which would not have distorted the market. So it's not a great policy, and who knows if it comes in place. And my instinct is it's just going to make it harder for people to upsize. I don't think it's going to cause many other problems beyond that, but it's gonna impact the luxury market.
All right, we'll keep tracking. There were a few questions on that, so we'll keep tracking that tax as it makes its way through the process. And I understand that we have Dave now on board.
Beautiful. All right, everyone. David Larock joining us, as always, mortgage broker extraordinaire, integrated mortgage planners. As I said at the top of our segment, if you do not follow Dave or read his commentary, you really should. I mean, I don't know anyone who kind of distills what's going on in the mortgage landscape with the Bank of Canada. I mean, Dave's like one of the few people who reads every Bank of Canada policy note or announcement that comes out and actually kind of summarizes it into plain English. So it's great that we have him here every month to unpack what's happening. So thanks again, Dave, for joining us.
Thanks for having me.
So maybe we can kick off sort of on some of the latest trends you're seeing. I mean, obviously Bank of Canada paused this month, but what do you see kind of going forward, given the outlook for inflation, obviously the slowdown we're seeing in the economy. I mean, what's your kind of read on where we're going for the sort of the second half of this year?
Well, we're at a turning point, I think, John. The question is how long the turning point is going to take to play out. I guess the first thing I'd say is right now the bond market thinks that the Bank of Canada is done. The futures market prices in what it thinks the Bank of Canada is going to do. And leading up to this meeting, at one point, there was about a 50% probability the Bank of Canada was going to hike by a quarter point at this meeting just passed last week. And the bond market was assigning a 90% probability that the Bank of Canada would raise by a quarter point between 2 weeks ago and the end of the year. Then we got a weak GDP print, and all of a sudden the bond market basically priced out any chance of a Bank of Canada rate hike last week, and a 10% chance that the Bank of Canada increases again before the end of the year. Now, that's significant for lots of reasons. First of all, people are wondering when we're going to get rate cuts. The gap between the Bank of Canada's last rate hike and its first rate cut is typically about 10 months. Now, history doesn't always repeat. It often rhymes, as Mark Twain said. So we don't know for sure it'll be 10 months, but the market is sort of is making some assumptions now about where rates are headed based on the belief that A, the Bank of Canada has now peaked, the Bank of Canada's policy rate has peaked, and B, on the idea that we're probably about a year away from the first cuts. Those are all reasonable assumptions, but I think anybody projecting certainty right now should be looked at skeptically, because there are a lot of moving parts. Let me give you an example. We all knew that after 10 rate hikes and the sharpest series of tightening that the Bank of Canada has ever done, that the economy would slow. And the GDP print was basically confirmation to the market that basically the lag effect, because rate hikes occur with a lag, the lag period had effectively passed, and that the economy was really going to start to feel the bite of those rate hikes. The average time it takes for rate hikes to exert their full impact is about 18 to 24 months. That's according to the Bank of Canada. And the first hike we got was last January. So we're actually just now 18 months from the first hike we got. And there were 9 more after that. And the first hike was only a quarter point, and the ones that came after were a lot more than that. So everybody expects the economy to slow, but the question is, will it slow fast enough for the Bank of Canada to hold tight? The Bank of Canada would like to allow time for rate hikes to do their work. But the challenge the BOC has is inflation has remained elevated for a long time now, at least in the eyes of consumers. It's felt like a long time. It's going to keep going up for the rest of this year. When you look at the average cost, average wages are rising by about 5%, and they slowed to 4% in July. We just got confirmation that average wages year over year grew at 5% in August. Energy prices have been falling and have helped inflation drop up till this point, but they're up about 25% from their lows in June. And it's expected that they'll continue to rise over the near term. So we've got 5% average wage costs. The service sector, which is the most sensitive to interest rate hikes, 80% of the average service sector cost is tied to the cost of labor, and labor costs are rising by 5%. Energy prices are going up. We've also got falling productivity. When you have higher wages and falling productivity, basically what that tells you is it's getting more expensive to produce the same amount of goods. That's inflationary. We also have the base effects, which is a bit complicated, but long story short, the consumer price index looks back over 12 months, and every month, a new month of CPI data is added on the front end, a month falls off the back end. The months that fell off the back end in the first half of this year were averaging 1%, which for a month over month increase is huge. And what that meant is we were adding about 0.3% month over month inflation growth on the front end, and we had about 1% month over month growth falling off the back end. Going forward, the average month for the next 6 months that will be falling off the back end is about 0.02, so basically zero. And the months that we added, the most recent month we added month over month was 0.6. So imagine that shift of the stuff falling off the back was the prices were higher than the prices being added on the front. And now the prices being falling off the back are lower, and the prices being added on the front have actually gone up. So take higher gas prices, take 5% wage growth with falling productivity, take the tailwind from base effects becoming a headwind. All of the short-term indicators suggest that inflation is going to rise for most of the rest of this year. Now, if you're the Bank of Canada, you've got to worry about inflation expectations, because as important as inflation is, even more important is what consumers and businesses think is going to happen with prices. If they believe that inflation is going to remain high, in other words, if their expectations that we're going to get back to the 2% target become what the Bank of Canada calls unanchored, then people start changing their behavior. They buy more now because prices are going to be a lot higher in the future. And as they start doing that, they bring more demand, future demand forward into the present, and that stokes inflationary pressures. And the more inflation expectations become unanchored, the harder it is for the Bank of Canada to bring them back under control. So even if the BOC thinks that the rate hikes they've made thus far are going to do their work, if it takes too long and inflation expectations remain elevated and the risk that they become unanchored rises, the BOC may have no choice but to hike again, just to basically drive a stake through the heart of inflation expectations. So it's all very complicated. Long story short, we're probably done. If we get another hike, I think it's probably only a quarter point. It's reasonable to hope that a year from now rates will start falling. But the bottom line is the BOC's rate hikes don't control all aspects of inflation. They control service costs. They don't have as much impact on goods production and goods prices. And they also have no impact on global energy prices, and those are swinging up again. So still a lot of unknowns. I think we're definitely near the peak. Are we at the peak? I'm less confident of that than most of the forecasters.
Dave, that's super helpful. I'm gonna ask you a question, and we can pull out your crystal ball. I mean, we've talked about this in the past. I mean, you know, the economy's slowing, right? We're feeling the weight. I mean, I'm seeing it on the ground. I don't know if you just even anecdotally, like a lot of households are feeling the weight of not just inflation, but the cost of higher borrowing costs. I mean, Canada is a very leveraged and indebted country, indebted households. And we're going to see the weight of that on households over the next 12 months, on the economy over the next 12 months. So, you know, what happens when the economy slows down? I mean, the GDP print remains negative, but inflation is still ripping. I mean, partly because interest rates are so high, partly maybe because oil is so high and they can't control that. You know, what is the Bank of Canada doing in that environment? Do they, I mean, like you said, just keep it high, or maybe even hike again to just kill the inflation? I mean, even if inflation is ripping for things that are, I mean, somewhat out of their control, like gas prices. I mean, what does that look like, and what do you imagine might happen in that scenario?
Well, the Bank of Canada has been very clear about what they will do in that case. They've basically said we've got one mandate, and that is to maintain price stability, and price stability is defined as a 2% inflation target. And they've been very clear that if the economy slows but inflation doesn't come down, they're going to keep their boot on the neck of inflation, and the pain that we're going to have to endure is going to intensify. But they say the pain of letting inflation run unchecked would be worse. And it's always hard for people to believe that, right? You could feel the pain of higher interest rates. You can't feel the pain of higher inflation. So we have to take them at their word that it would be worse. I think it's true. I think they're right. But that is cold comfort to people who are being so negatively impacted by higher rates. But that is the answer, John. If they can't bring inflation down, then consequences be damned. Their mandate says they have to use rates and keep monetary policy tight. Again, they're using quantitative tightening too. They're allowing all of the bonds they bought on their balance sheet during quantitative easing, which is basically unnecessary at the time. They're pushing those back into the market, which is driving bond yields up, and that's also impacting fixed rates. Yeah, there's no question. And the reality is, the frustrating thing, there's two things about inflation that really frustrate people. Number one, if we have inflation in areas where the Bank of Canada's rate hikes really can't control those prices, the Bank of Canada knows this, but what they're going to say is if those prices are too high, we're going to jam the prices that we can control down even farther. And even though we can't directly impact the inflation, the prices that are really driving inflation, we can create deflation in the areas we can control to balance the two out. And there again, that's frustrating for people to experience, because what they're saying is the kind of inflation you guys are tamping down isn't the kind that's the problem. And the other thing that drives people crazy is that a lot of the inflation we have today is higher borrowing costs. And people say, well, the Bank of Canada is causing this inflation. Well, the Bank of Canada says, not really. We need this kind of inflation to control the other kind of inflation. And basically, you can't have it both ways. The Bank of Canada's mandate doesn't exclude the cost of borrowing. It is part of the inflation basket, and that isn't going to change their mind. So again, John, very complicated, but the Bank of Canada has been clear. Inflation is their mandate, and they will stick to that regardless of the pain that they know they're causing, because they think the alternatives are worse.
That's actually a good, I mean, you did a great job. Let me try to maybe unpack it for people who are not as familiar with inflation. You can kind of tell me if what I'm saying is wrong. So, I mean, if inflation, of course, is really about the cost of a basket of goods, you know, food, travel, housing costs, mortgage payments, rent, all of these things. And what it sounds, and we'll often hear in the news, like David said, that, you know, and you'll hear a lot of economists say raising interest rates does not lower or impact oil prices, you know, and oil prices are contributing to high inflation. But what's interesting, what you said, is that the Bank of Canada's response, which, I mean, I haven't heard a lot of people say, is, well, I don't care about that. What I'm going to do is keep jacking rates up to try to push the other costs even lower so that the entire basket of goods remains at 2%. So not just kind of cool the growth in the other products, potentially even drive their prices down, like deflation, to kind of balance out the things that they can't control. And I think that's, I mean, that was a very interesting insight that you kind of pointed, and I haven't actually read that from other economists. Usually people are just kind of criticizing the fact that higher rates cannot control gas prices, but I think that's a good example that you gave us today.
Yeah, thanks. Well, I think you've described it well, John. Absolutely. And by the way, another argument that we're hearing a lot nowadays, or I'm reading in the mainstream media, is a lot of economists are arguing that 2% is a silly target, that it's arbitrary and we shouldn't be using it, and that we should use 3% instead. And if you're the Bank of Canada worried about inflation expectations becoming unanchored, the argument that 2% is silly and we should just live with the fact inflation is going to be higher now and we should punch the target up to 3%, that's about as clear an example of inflation expectations becoming unanchored as the Bank of Canada would ever want to see. And if you're the bank and you're thinking, can we keep rates where they are and let the economy slow, even if it means inflation has to run hot for another 6, maybe 12 months, the reality is, when you read those arguments that mainstream credible economists are saying we should just bump the target up and solve the problem that way, I'm sure that's concerning for the bank, because inflation expectations are they're watching them very closely, and that narrative is growing.
That's helpful. Awesome, David. Urmi, I don't know if we have any questions specifically for
No, Dave, you explained everything so well, and John, your questions are dead on. So I'm going to take the silence as a reason for that. But I agree with John. It was very, very clear and helpful to hear about, the closer look at how the instrument of the inflation rate can be the instruments they have to tackle it, and how they might think of things in the basket as being different. I have one question for both of you in terms of how housing itself is really contributing to these high costs in the inflation rate itself. How much do you think, Dave, that calculus is part of it? Or do they just, that's one part of the basket they really have a hard time controlling with, you would think interest rates would be a one-to-one dampener on home prices. We haven't seen as much of that as we would have expected, right?
Yeah, well, so how consumer spending and housing activity are both down now, and those are very sensitive to interest rates. So basically, the Bank of Canada is seeing the impact now of higher rates on the most interest rate sensitive parts of the economy. But it took a long time. Back in January, when the Bank of Canada said that they were going to pause, the housing market went nuts. It didn't take rate cuts. All it took was saying rates weren't going to go up anymore. And then the US banking crisis happened. US bond yields plunged. They took Canadian bond yields with them. All of a sudden, we had significantly lower fixed mortgage rates in the spring, which is major stimulus for the housing market. So the Bank of Canada saw its own decision to announce that it was formally pausing undo the impacts of tightening. Basically, the housing market got hot again. Then it was given more stimulus by lower rates because we're tied to the US, Canadian bond yields are tied to US bond yields, and that drove our fixed mortgage rates down. Again, not what the Bank of Canada wanted. And we've also had an elevated level of pandemic savings, which have allowed consumers to absorb higher prices without having to reduce spending. Normally, higher rates increase the cost of everything, and that means people have to cut. They have to decide when they look at their budget, where am I going to spend less? But because we had lots of pandemic savings available, people were able to maintain spending. So basically, higher rates weren't having much impact at all. We were still getting really strong economic prints, and nobody was confused about why it was happening, but it must have been frustrating for the banks. So now the pandemic savings have been depleted significantly. I don't know if they're all gone, but basically we're seeing some pullback now in consumer spending. Household activity is slowing. But quite frankly, we need to see more of that in order to bring inflation down, and certainly to satisfy the Bank of Canada. And the only question they have to ask is, have we done enough, or do we need to do more? Because it's like the Bank of Canada's rate hikes occur with such a lag. It's kind of like hitting the brakes in an oil tanker in the middle of the ocean. You got to slide forward 10 more miles into the ocean to find out whether or not you got the pressure right on the brakes. And by the time you find out whether you got it right, you're too far down the road, and anything you do in that moment is going to have the same lag as the original cuts did. So it's a tough job.
Yeah, and you've explained that before. So normally that sensitivity between interest rates and the housing market should be a little bit, it should be quite sensitive to it. And we saw, as you've explained in previous sessions, this really unusual anomaly of, the pandemic and those built up savings kind of interfering with that. And you are now suggesting that we're seeing a little bit of that return to the normal relationship.
Definitely. We should see a more direct impact. The pandemic savings and the rally in bond yields tied to the US banking crisis were interrupting the transmission mechanism between Bank of Canada rate hikes and consumer spending and housing activity. And that transmission mechanism is normalizing now. And what we're seeing at this point, and what we saw in the latest GDP data, is confirmation the rate hikes are doing what they're supposed to do. And that's why the bond market reacted the way it did. It basically said, okay, the Bank of Canada is done. We can assume rates have peaked. But the bond market has a tendency to overreact. It shoots firsts and asks questions later. And as I said in my most recent blog post, with high wages, high energy prices, productivity falling, there are lots of reasons to believe base effects that inflation isn't going to come down quickly. In fact, and this will be interesting, guys, over the next few months, we're going to see inflation rise. We'll see what happens to market psychology and the impact that has on the bank and on bond yields. I think over the short term, we're probably at a low now, and I think yields will probably go up from here. And I wouldn't be surprised if the future markets bets on Bank of Canada rate hikes start increasing as we get these higher inflation prints, which at this point are almost inevitable.
Wow. I mean, that's not good news.
No.
Who invited this guy?
Well,
balls and strikes, John, just like you.
Yeah. Maybe I will give a last quick hit. I know we're right up against the time to a last viewer comment. Adriano asks, historically speaking, aren't the current level of rates moderate? The point of view that rates are very high right now is only in comparison to the post 2008 cycle there. So
I think the challenge with that narrative, I mean, again, I think we're learning lessons from history. I mean, anyone whose family has owned real estate and lived through the 80s or the 90s, we'll hear the stories. Back in my day, you don't know what it was like. Interest rates hit 15% and so on and so forth, right? And all of us, our generation, you know, because we're so arrogant, you know, our reaction is, well, you people don't know what you're talking about. That's never going to happen, right? Now, the problem with this arrogant assumption is that we don't need rates to hit 15% because our debt levels are 5 times what our parents' generation had, right? So going from 2 to 6 is the equivalent, and probably actually worse than what they experienced because their debt levels were so much lower, right? So we're actually kind of going through, I mean, for those of us whose parents kind of experienced it, the same thing that they went through, you know, and 20 years ago, we're going to be telling the next generation that they don't know what they're talking about because we remember when rates hit 6%. So yes, it's a good point. 6% is not historically high, but it is high when you have the debt levels that Canadians have, and we are way more indebted than Americans, right? And Americans also have the benefit of the fact that when they get mortgages, they're usually 30-year mortgages. They don't renew every 2 or 3 or 5 years the way we do. And they put that in place, quite frankly, because of the what's it called, the 1930s Great Depression, because exactly kind of what we're experiencing in Canada, all these mortgages were resetting, rates were surging, people were kind of defaulting because they couldn't handle the rate increases, so they introduced basically 30-year mortgages. I think after the 1930s, Canada never did. So, you know, yes, they are historically low, but not based on today's kind of debt levels. So, I mean, that's my rant. I don't know if David has anything to add to that.
100%, John, you nailed it. 6% today feels like 20% in the 80s because our relative debt levels are so much higher. And the reality is, if interest rates ever they peaked above 20% in the 80s. If they go above 20% now, we'll all be guarding our vegetable plots with rifles, and nobody will be worried about mortgages or interest rates.
Yeah.
All right. Well, thanks, Adriana. You left us on a fiery note. As usual, the viewers make this session. So thanks everyone for your questions. And our show notes have all the contact details for John and for Dave, whose insights, as always, were excellent. Thank you.
Awesome. Thanks everyone for joining. And thanks again, Urmi and Dave, for joining us this week or this month. Okay, everybody, we'll see you next month for our next market update. Thanks again, and send us all your questions. All right, I think we're done.